battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office for the past 43 years. It's been our mission to deliver both clarity and confidence to help secure your financial future. We are back. We're bigger than ever before. Episode 151. Grab your machete. A little bit of a reference to the jungle. Like I told you, I think we are in right now, the jungle years in the stock market. Welcome back. I know we took 2 weeks off. Let not your heart be troubled. We are back, and hopefully we'll not be missing too many more shows for the rest of the year. Had a little bit of travel come up to go see some clients. We are actually in the middle of opening up our brand new, beautiful Houston spot, expanded space across from ExxonMobil's campus. Don't wait to come see it. We got a couple of big trips coming up. I'll be down there in June and July and probably again in August. So we'll see you down there. If you are in Houston, come see the new spot. It's absolutely stunning, great new space in Houston. And of course, the Naperville office, almost said Oak Brook. We used to be in Oak Brook. We're in Naperville, is booming. So we can't wait to see you this summer in person. I would encourage you to subscribe to the show. You can watch it on YouTube, Apple, and Spotify. If you're not already subscribing, it helps us get it to more and more people. We appreciate you doing that. Share it with the friends, with friends and family here. Why? Because we know that the doom and gloomers are going to scare people off their plans. And if you can get the good news, the clarity, the confidence, the data to your friends and family, hopefully they can stay the course. So share it, like it, subscribe to it on YouTube, Apple, and Spotify. Thank you so much for joining us each and every week. I do want to make a couple of brief announcements. We just did a 2024 political and tax outlook webinar. That was myself, Chris Jordan, who put that together. Don't miss it. It's on YouTube. The recording is available. Go ahead and watch it. And even further, if you'd like to, schedule a time, if you haven't already, with Chris Jordan, our head of tax. He's a CPA, master's of tax, best in the business, does a nice job, and have him review what you did last year in 2023. Now's a good time to get a second opinion, and he may be able to look at what you're doing and give you some pointers. He may say everything's going okay, but at least talk to him. Watch that webinar on YouTube, the 2024 Political and Tax Outlook, because there are some tax changes coming up in 2026, and you need to be prepared for them. So that's number one. Number two, we did a phenomenal podcast. Many of you have watched this with Marta Norton, CFA. She is the CIO, the Chief Investment Officer for the Americas at Morningstar. Morningstar is one of the primary investment management data providers. They do a phenomenal job, been around for a long time, actually got their start right down the road from us in Chicago. And you got to go listen to that podcast. Absolutely phenomenal. And then I will just make a reference lastly here to 2025 Investor Day, which happens, of course, in this year, 2024. It's going to be November 7th and 8th, downtown Naperville, again at Hotel Indigo. And it's going to feature Dr. Ed Yardeni, who is the president of Yardeni Research. He is even more bullish than we have been, but he's been right on the money. He's been spot on. He's saying the S&P is going to go to 6,000 points. Right now it is in the 5,300 point zone as we're recording the show. Dr. Ed has been spot on the money, and you got to come and see him live. And we're trying to bring you the biggest and best names in the financial industry community, the best advice, the best clarity and confidence, all the data, all the research, all the math and statistics, so you can stay bullish long run. So that is coming up November 7th and 8th. We will send out an invite link very soon, a registration link. And that thing fills up really quick. So you got to get on the invite very soon when it comes out. So those are all the announcements for today. We're going to get into episode 151. Grab your machete. And the broad point I'm trying to make with the episode of this show this week is you got to distinguish between high quality and low quality in the market. Not every stock is created equal. Not every company is managed the same way. Not every industry is has the same quality metrics across the board. Not every oil company is run the same way. Not every financial services or banking institution is run the same way. And you have to know what you own. And when you go through these jungle years in the stock market, it becomes even more and more important to really sift through the garbage and get to the high quality. And I want to make this point in a very easy way. We run we call it our Stenger quality screen, but we start with the entire U.S. stock universe. There's about 8,293 companies. So write these numbers down if you're following along at home. 8293. That's the number of U.S. publicly traded companies. There's only 1,933 that are actually profitable. That's 23%. If you sift down through that 1933 and you go to not only profitable, but growing those profits and revenues over time, it's about half of that. It's about 1,093 that are actually growing those profits, growing their revenue. That's 13% of the original 8,300 that we start with. And then if you filter down to the balance sheets and you look at the quality metrics of how strong are these balance sheets, how good a shape are their cash positions, how much debt do they have, you get down to 297 companies out of the 8,300 that you started with. That's only 3.5% of the universe. And then, we like the large caps. We like the biggest and best because of the Matthew principle. And you get down to 96 large cap companies out of the 8,300 original companies, 1.15% of the entire universe that are stocks that pass the Stenger quality screen. And this is why I keep encouraging you, be careful with what you own. There's always, I shouldn't say always, but there's almost always a canary in the coal mine of companies before they go bankrupt. There's almost always something that's going wrong well in advance where it should show you, hey, here are some warning signs. It's not a fail safe. It doesn't work every single time, but by and large, you should see some warning signs unless there's some fraud going on at the company or something, radically out of the mix. You should see some warning signs ahead of time. And I'll just give you one easy example. I'm not giving you investment advice here. I'm not telling you to go buy it or sell it or anything like that. So don't take it like investment advice. This is just an example. But Walgreens, the darling of Wall Street in the 80s, in the 90s, even the early 2000s, was growing at a clip of 21% per year for 20 years in the 80s and the 90s. What happened was Walgreens really did not pivot its business model quickly. I think maybe there could be a turnaround story eventually there. I'm not sure. But they just could not make the pivot to online like Amazon did. They just could not keep up with customer preferences. And Walgreens now, after the opioid settlement, which was a multi-billion-dollar settlement with Purdue Pharma and all the rest of these big companies that had to pay a bunch of money to settle the opioid problems, is now really struggling with its cash position. It's laying off workers. It's talking about closing stores. They're dealing with theft on the West Coast in San Francisco. People literally just walking in because of the laws that they have out there. You can steal, I think it's $1,000 of merchandise or like $990, and you're not going to get prosecuted. So they're closing these stores. Target's having the same problems. Walgreens in particular, though, because of that opioid settlement, has gotten itself into a really bad spot from a cash standpoint. And now the stock the past 20 years has only gone up 1% per year, including dividends. And so things like this can happen in the market. You got to watch out. A company that was doing well for 20, 30 years may not do well the next 20 or 30. There's a reason why in all of our materials that we put out, we put a little disclosure on there that says past performance is not a guarantee of future results. And the reason we put that on there is exactly for companies like Walgreens. Just because a company grew each and every year, double digits, great growth numbers, 20% returns, that's phenomenal. Doesn't mean it's going to grow forever. Doesn't mean it's never going to have issues. And that's why you have to be constantly looking at the portfolio, rebalancing, and just making sure, in our opinion, again, not investment advice, but our opinion, that you're in the top and best names. Because when you go from 8,300 in the entire universe that you can buy down to 96 companies, it just shows you it's pretty basic math that there's just not that many companies that you probably want to own long-term in the stock market. Now, could we miss some of the up-and-comers by being in the top 50? You say, Nick, aren't there some small caps that are going to become mid caps and mid caps that'll become large caps? Yes, but statistically speaking, you're going to have a lot more large caps become mid caps and small caps than mid caps and small caps becoming large caps. That's just part of life. There's creative disruption when you're in a capitalist environment. True capitalism, not crony capitalism, where companies actually can fail. We're not too big to fail like we had in 08 and 09. That's crony capitalism. That's not real capitalism. Real capitalism, companies that don't do a good job literally go bankrupt. And so that's one of the things that we never talk about when we get into the billionaire debate. And right now, one of the big stories is talking about Elon Musk and that massive pay package that he's up for. And people are saying, hey, how come Elon Musk needs another $56 billion? This is ridiculous. The rich are getting richer, the poor are getting poorer. How come Elon musk needs another 56 billion? Well, that's not the major question you should be asking. The question is, what did Elon Musk do to deserve the $56 million? And the answer is he delivered incredible results for shareholders. Now, Tesla stock's not up this year. It's down quite a bit, but you look at Tesla the past 5 years since shareholders started approving these plans for Elon Musk comp, and he's grown the company exactly like he said he would. He delivered incredible results, incredible returns for shareholders. And so if you're a shareholder in Tesla, you should want the CEO to make a lot of money. You should want him to be engaged. You should want him to own a lot of the stock, because the societal good that a CEO or an entrepreneur or an innovator is doing is going to have a much broader impact on the broad economy, on you and I, our day-to-day lives. Entrepreneurs, innovators make our lives better. They reduce costs. And that's why we should want more of that. We should want entrepreneurs and innovators to do better than ever before. Why? Because it encourages better outcomes for the rest of us. And so that's why the rule of law and personal property rights, that's why the United States has become the preferred destination for entrepreneurs all over the globe. Don't miss this. Don't forget about the fact that there's a reason why people innovate here. Europe has a tremendous problem with innovation. We cannot get I shouldn't say a single company in Europe to innovate, but it's very hard. There are a select group of names in Europe that are innovators. There's a select group of entrepreneurs, but a lot of the best European entrepreneurs, much like the Chinese entrepreneurs, have come to the United States. They've built their companies here. We have much better financial regulation. We have much better transparency over financial statements. And so we have a high degree of reliability that the companies we're investing in are pretty darn good companies. And so that's why I say, watch what you're owning. When you're in these jungle years, the stock market, I believe, is going to keep going on up. And I think go on to make brand new all-time highs. And I think Dr. Yardeni's estimate that the S&P is worth 6,000 points, that's what he thinks fair value is. I think we're going to get there. Now, do we get there by the end of 2024? I really don't think so. I think we're probably going to have a decline here before the election. We're probably going to have some sort of a pullback before we figure out who the new president is. But you got to remember, next year is going to be the first year of that presidential election cycle. That's year one. And year one of the cycle is always a positive year. And we're not talking positive single digits. We're usually talking positive double digits in the stock market. So could we get to that 6,000 estimate like Yardeni says? Absolutely. It might just take us 18 months or 2 years or something like that. But knowing that, you should be a bullish person. You should be optimistic on the future of U.S. companies. And I was going to mention this at the end of the show today, but I'll just mention it again now, that the FactSet earnings insight that came out 2 weeks ago pointed out that in the first quarter of 2024, this year, earnings on the S&P were just knockout, blow your face off earnings. And you had 5% earnings growth on all S&P 500 companies. Here's the crazy stat. If you took out one company, Bristol Myers Squibb, BMY, you had like 7.5% earnings growth. Well, if you took out three of those companies, you took out BMY, you took out Gilead Sciences, and then you took out, I believe it is, let me get it for you, Pfizer. Those three companies, BMY, Pfizer, and Gilead, you had over 10% earnings growth in the first quarter on the S&P 500. So why is the S&P up 8, 9, 10% this year? because earnings are up 8, 9, 10%. And it's not this narrative of just 3 or 4 companies driving the bus. Now, you got NVIDIA that's producing unbelievable profits, unbelievable revenue. And I think NVIDIA is going to continue to do well. We may see a pullback at some point. You can go back and watch myself and Sam Hardy on Bullish. Last year, we did a show called NVIDIA Lives Up to the Hype or something to that effect. And we said, hey, this company's grown profits. It's grown revenues. It's got a phenomenal business model, got a great balance sheet. This thing's going to rip. Now, not individual stock advice. You got to do it on a plan. You got to have personal financial advisor tell you what to do. But you can find these companies ahead of time. You can look at these screens. You could say, hey, there's a good company that's growing profits and growing revenues. So there's good companies out there. You can find them. You got to take the machete. You got to chop down the trees in front of you to find the good opportunities. But they are out there. Now, I just want to talk about one other company as an example. Again, not investment advice, but just as an example of the opposite of NVIDIA, where great company, but if you paid the wrong price for it, you are paying the price now with the stock. And that's Salesforce.com. CRM is the ticker. It's a CRM company. They say they're big data. They say they're all these, collaboration tools for the workplace. And of course, we use Salesforce in our day-to-day at Stenger Family Office. Most large companies do. It's a really good tool, really good product, a great company doing a lot of revenue, pretty decent balance sheet. But here's your problem. Stock is down about 18% while we're recording the show today. Why? Because it's the wrong price for those earnings. Okay, so this is where you have to be careful. And Warren Buffett pointed this out, that it doesn't matter if you find the best company on earth, doesn't matter if you find the best balance sheet, best revenues, best earnings growth, but if you pay the wrong price for all of that stuff, you could be holding the bag when there's a correction. And you saw this in the late 1990s in the melt up leading up to the tech bubble and the tech crisis. Cisco still, great company, still has not returned to the levels, the peak numbers it was at in 1999. Why? Because people paid the wrong price for its earnings. Now, I mentioned this on a show a few weeks ago, but I'll just remind you again, in 2020, remember the Dow Jones index, and you might think, Nick, I'm an index investor. I don't like to buy, pick stocks or anything like that. I get that. I understand it. Okay. We're not really stock pickers either. We just like to look at the top 50 and screen out the garbage. So I think that's reasonable. But every index, whether it's an index or not, is actively managed to some degree. Okay. There is a committee behind the S&P. It's called Standard & Poor's, and they actually vote on what goes into the S&P 500. Same thing with the Dow. And so during 2020, when we were having the oil crisis, oil prices went negative. All the oil companies that had inventory, oil on their balance sheet, literally were paying money to hold the oil. That's what happened. It was crazy. I mean, a lot of these large oil majors like ExxonMobil and Chevron were really struggling in 2020. And the Dow Jones Index basically voted to take Exxon out of the Dow at all-time lows. Stock was trading like $28 or something like that, and replace it with Salesforce. They paid 1,800 times earnings to put Salesforce into the Dow. And if you look at the performance now, coming out of 2020, again, Salesforce isn't a bad company. I'm not saying ExxonMobil is the best managed company on earth. Pretty well managed. Not the best managed out of every company on earth, but really, really good nonetheless. Salesforce, pretty decent company. Okay, decent management, decent earnings, decent revenues. But you paid the wrong price for its earnings in 2020. ExxonMobil's outperformed Salesforce like 100 to 1 or something like that now. So it's really important that you look at what you're buying, what you're owning, when you're buying it, what price you're paying. That is the jungle factor. And so you come into the jungle, you got your machete out. If you don't sift through the garbage, you could be left holding the bag. And this is why I say, watch what you're owning. Look for quality. What are some of the risks to investors? Well, the biggest one is not the political environment. Yes, politics can impact the direction of where business goes and where earnings go and where profitability in the S&P goes, which impacts stock prices. That is true, okay? But at the same time, it's not the biggest factor. What we're really looking for here is cost of capital. And that's why the Federal Reserve matters. That's why you do have to pay attention. As much as we don't really want to, we do have to pay attention to what the Fed's doing, because when they raise rates to 5.5%, it can create a problem for cost of capital for companies. And if Capital costs people, if the risk-free rate is 5.5%, and then a bank is going to put 4 to 5% spreads on top of that, it costs a company to borrow 10% in interest, and you can't grow your profits by 10%, which is already a high bar for a lot of large companies anyways. You're going to sit there, you're going to say, hey, let's wait a second. Let's see what rates do. Maybe we're going to do some layoffs. Maybe we're going to cut back on capital expenditures. Maybe we're not going to grow as fast. That's the entire point of the Fed. So here is my note on the Fed. Inflation is stubborn. It's not going down. We're not surprised by this. If you've been following the show, you've been listening to the stuff we put out, I've been telling you, higher for longer, higher for longer. Inflation's not done. Watch out. Stuff is going to be expensive for a long time. Okay. That's just the reality of the big print and spend agenda that we have. Okay. But inflation now is subsiding a bit. Okay. On the big things. And so used cars, autos are down a little bit. New cars are actually coming down. We have home prices moderating a bit. We do have a little bit of a slowdown. Remember, the Fed is operating on a lag. I think the Fed needs to pause. I think they need to come back down from 5.5 to 3.5, which is still restrictive. And the fact that they're not doing this is insane. Now, do we see some cuts before the election for political reasons? It's very possible. And we saw that in the 70s. Arthur Burns could not keep inflation tamped down. He did not keep rates high enough for long enough, and inflation came roaring back in the 80s. And remember, Paul Volcker had to come in and fix it, raise rates to 19%. Are we going to get there? Is it going to be that bad this time? No, thankfully, I don't think so, because we have a radically different economy today than we had back in the 70s and 80s. And I think this is one of the big things the Bears have missed the past couple of years is there's two competing narratives going on. Yes, things are bad with certain aspects of the economy. Yes, inflation is bad. Yes, there's probably an economic recession coming. However, our economy today is so tech-driven, so tech-reliant. Technology is very inexpensive relative to building a factory, relative to buying equipment and machinery and inventory and all this stuff. And a lot of companies can still grow today by leveraging technology. And so the saving grace of the economy now is not the government. I remind you this every time. Okay, like Ronald Reagan said, scariest words in the English language, I'm with the government, I'm here to help. No. The government causes the problems in the first place. Then they try to come in with the solution. The saving grace of this economy, make no mistake, has been entrepreneurs. Entrepreneurs have saved the day with technology. Now, is the entire economy built on this fantasy of AI and NVIDIA and all this stuff? No. AI is a big deal. It's a big piece of what's going on, but there's a lot more past AI that's going to be even a bigger deal to companies. And one of those things is machine learning. Another is autonomous. Another thing is robotics. And so if you look at just as an example here, again, not investment advice, not telling you to go buy the stock, but Tesla in particular just did a 20-page presentation for investors where they're talking about, hey, Tesla's not just a car company. We've got all this autonomous technology. We've got this Optimus robot, which is a little scary, but very impressive. We've got this other technology that's incredible. We've got the driverless taxis. We've got all this stuff in the pipeline coming down. And that's what powers earnings forward. We've got a labor problem in the country. We got way too many open jobs and not enough people to fill them. We're going to fill them with some of the technology coming. And that's the bull case for equity. So could you see this competing narrative? Doom and gloom. There's problems in the economy. There's issues out there. There's inflation. Yes. At the same time, almost seems a little bit contradictory what I'm about to say, but at the same time, our company's growing earnings and growing revenues and growing profits. Yes. You could see both of those things happen for a while. And so that's where you have to, if you're a politician, you have to be a little bit careful. You could get into a wage price spiral. Growth. We're seeing earnings going up, revenues going up. So we need people. We need to retain people. We got to pay them more. But at the same time, everything's getting more and more expensive. I think you're going to continue to see this dramatic shift the next few years between these legacy industries that have failed to innovate, that cost of capital is at 10%, 8, 9, 10%, and they can't grow revenues and profits 8, 9, 10%. They are going to fold. They're going to sell to stronger hands. That's the way a market economy works. So when you see the bankruptcies happen, when you see the problems come up, when you see the debt and the leverage come home to roost that all these companies took on at low rates in 2020, we're almost 5 years past that now, by the way. Next year will be 5 years officially past the low rates of 2020 when all these rates reset. Okay. If somebody took out a 5-year revolving loan at a variable rate in 2020, guess what? Just math. Next year it resets. This is going to cause bankruptcies. It's going to cause problems. But it's not every company. It's not every balance sheet. It's not every management team. Remember, 8,300 companies in the universe get down to 97, less than 100, about 1% that are still going to be fine and do okay. You think, Nick, isn't that a bad thing? Is that a big problem? It is and it isn't. Number one, it's part of life. It's part of being an investor. It's part of capitalism. When you have a competitive market environment, people are going to go bankrupt. That's just part of it. You're going to have management teams that mismanage. You're going to have management teams that did a nice job that were watching risk. Okay. JP Morgan, Jamie Dimon, great example of this, where they have a fortress balance sheet. They said, hey, we're not going to take the risky loans that Bank of America is going to take. We're not going to take the risky loans that SVB and First Republic are going to make. We're going to stay right in the middle of our lane. We're going to do what we know we should do. We're going to build up cash stockpiles just in case there's a rainy day. Jamie Dimon calls it a hurricane. Doubt that's going to happen, but let's just say it does. They're going to be okay. They're going to survive. So that's what you're looking for with quality. It's not companies that are going to insulate you completely from a market correction, but the hope is that you make it out alive. You live to see the other side of the jungle and make it to the promised land. So that's, again, why there's going to be, I believe, this difference between the bad companies and the good companies. You're going to see this widen out more and more the past 3 to 5 years, which is why you're going to want to be in the top ones. So that's all the bad stuff in the background. There's plenty of good stuff going on. There's plenty of innovation. There's plenty of entrepreneurship. There's plenty of reasons to stay bullish. Technology has never been faster than it is right now, like Brian Westbury pointed out, but at the same time, it's never going to move this slow again. And so the more and more you expose yourself and open your eyes to the science journals and the technology and the engineering journals, get some of them, subscribe to them, go on the websites, read the blogs of what's coming. It's just so exciting. And medical technology is getting better. We have some of the best minds working on some of the hardest problems in our country. And so I think over the next few years, you're going to see a couple things happen. Inflation will persist, but stock market returns are going to do just fine, which is why I've encouraged you, stay the course, stay optimistic. You may see a correction this summer. I think it's very likely you could see a little bit of a pullback. Don't let that spook you. If you've got a little dry powder on the sidelines, put that to work, buy some more stock, get a little bit more to work, and maybe you rebalance like we do, where you take some profit off the things that have done well, and you do that consistently over time, and I think you're going to be just fine. So stay on your plan here, stay on the course. If you can't do it all on your own, hire somebody that can help you. Give us a call. Give a good fiduciary advisor a call that can help put a plan together. Everything should be goals-based, not risk-based. You want to set up a plan where you're constantly thinking about how much is the market going to go down and am I going to make it? You want to have a goals-based plan that says, hey, let's have 3 to 5 years of living expenses and something that's short-term, that's high quality, that's low risk, and put that aside and never touch it. And then let's have the rest of our money in inflation-beating equities. And if you do that over time, I think you'll be in great shape. Give us a call if you need help with that. Number 630-912-8295. Go on the website, StengerFamilyOffice.com, and subscribe to the show so you can keep getting the clarity and confidence, the good news. Stay in your plan. Thanks for being here. We'll see you next week for episode 152.